86 million ounces. That is the number sitting inside COMEX registered silver vaults as of the weekly close on March 6, 2026. Now I know that sounds like a lot, but here is the thing. 3 months ago, that number was over 124 million ounces. That is a 31% drain in a matter of weeks. And when I tell you what that means for anyone sitting at home right now holding physical silver or silver-linked positions, I need you to stay with me all the way through this video, because what is happening in the paper market right now is the part most channels are not explaining properly. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos. I have sat in rooms where these decisions get made. I have watched what happens when retail investors get the wrong information at the wrong time. That is why I am here. This channel, Currency Insider, exists for one reason: to give you the same quality of analysis the institutions are getting, using only publicly available data, with every source named as we go. If this kind of calm, data-first breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, now is the time, because what we are covering today is part of a bigger picture we are building week by week. Here is what you are going to understand by the end of this video. 1. What the 31% inventory drain actually means and what it does not mean. 2. How the ratio of paper contracts to physical metal gets to a mathematically dangerous place. 3. What the Western premium over Shanghai tells us about where this pressure is really coming from. Everything I show you comes from publicly available sources, and I will name everyone as we go. So let me give you the current picture first, because the price action this week is telling us something specific. Silver spot, XAUUSD, settled at $84.58 as of the March 6th close. If you are holding silver right now, you have felt that move. A few weeks ago, this metal was closer to $79. That is a meaningful run. But here is what triggered this video. It is not the price. Price is the last thing to move. It is what is happening underneath the price, inside the vault data, that made me want to sit down and walk through this carefully. Before we go any further, drop in the comments right now. Are you seeing elevated premiums at your local dealer this week, or has it come back to normal? Whether you are in Ohio or Manchester, that information matters. The comment section here becomes a real-time sentiment tracker, and I read every single one. Here is what the CME warehouse report is showing us as of the March 6 weekly close. COMEX registered silver, and I want to be precise about that word registered because it matters enormously, has fallen to 86.1 million ounces. Now let me explain the difference between registered and eligible, because this is where most of the confusion lives. Eligible silver is metal sitting in approved COMEX vaults. It is physically there, but it has not been offered up for delivery. The owner has not said, take it. Registered silver is the metal that has actually been designated available for contract delivery. It is the metal that is, in a practical sense, on the table. So when registered drops 31% in a few months, what that is telling you is that fewer and fewer owners of physical metal inside those vaults are willing to make it available for futures delivery. They are pulling it back. Think of it like a restaurant that has a full kitchen storeroom. That is your eligible inventory. But the registered silver is only what the chef has actually agreed to put on tonight's menu. The storeroom being full does not help you if the chef pulls the menu items. That is the dynamic we are watching right now. Now here is where this gets structurally interesting. The CME data also shows us open interest on silver futures contracts, and right now we are sitting at over 100,000 contracts. Each COMEX silver contract represents 5,000 ounces. So do the math with me. 100,000 contracts multiplied by 5,000 ounces is 500 million ounces of paper silver commitments floating in the futures market, against 86.1 million ounces of registered physical. That is roughly a 5.8 to 1 ratio of paper claims to deliverable metal. Now before you run with that number, and I want to be honest here because this is where a lot of channels overstate the case, the vast majority of futures contracts never result in physical delivery. Most are settled in cash or rolled forward. The futures market is not a delivery queue. It is closer to a stadium with 500,000 people in it and a concession stand that only has enough hot dogs for 86,000 fans. Not everyone is going there for the hot dog. Most of them will leave before halftime. But, and this is the critical but, if even 15% of those open contracts demanded physical delivery at the same moment, the registered inventory would be mathematically empty. That is not a prediction. That is arithmetic. And that arithmetic is worth understanding clearly. If you know someone who has been watching silver this week and trying to make sense of these moves, share this video with them right now. This breakdown took time to put together, and the people who need it most are probably not searching for it. Now here is the piece that actually stopped me when I pulled up the data this week. We are seeing a Western premium over Shanghai prices of approximately 1.74 that works out to roughly 2.1% above the Shanghai Futures Exchange price of 82.84. Stop. I want to sit with that for a second because it matters. Normally, when people talk about a silver squeeze, they assume it is a global phenomenon. East and West both scrambling for metal simultaneously. But what this premium data is telling us is something more specific. The pressure right now appears to be predominantly Western-led. It is not Shanghai driving this. It is COMEX. Western shorts, traders who have sold silver futures they do not physically hold, appear to be the ones scrambling. Now, before you run with that either, I want to add the caveat I always add when looking at cross-market premiums. Premiums between Western and Eastern markets can reflect local taxes, financing costs, market structure differences, not purely physical scarcity. So we are not looking at this number in isolation. We are looking at it alongside the vault drain, alongside the open interest ratio, alongside the macro backdrop. And when you look at all three together, the picture becomes more coherent. This is genuinely one of those weeks where multiple signals are pointing in the same direction. And in 15 years watching these markets, that alignment is always worth paying attention to, even when you cannot be certain what it means yet. Let me give you the macro layer because you cannot look at silver in isolation this week. The US dollar index, the DXY, slipped to 98.99 following the February non-farm payrolls release, which came in showing 92,000 job losses. That is a significant miss. When I saw that number come through, the first thing I did was pull up the 10-year Treasury yield, sitting at 4.13%. Now here is the tension that is worth understanding. You have a weakening dollar, DXY below 99, and a 10-year yield still elevated at over 4%. Normally, those two things move in opposite directions. The fact that they are both doing what they are doing simultaneously tells you the market is genuinely uncertain about what the Fed does next. And that uncertainty is pushing institutional money toward tangible assets, toward commodities, toward metal. On the UK side of this, and for viewers watching from Britain, this matters directly. The LBMA, the London Bullion Market Association, remains the global benchmark for silver pricing, and London vault activity has been a key part of the physical flow story this year. Bank of England reserve positioning and broader sterling dynamics are worth watching alongside the dollar weakness, because if the dollar softens further, the relative attractiveness of commodities priced in dollars increases for sterling holders as well. The de-dollarization trend is also worth naming here plainly. Central banks globally, the World Gold Council has documented this clearly in their most recent reserve data, have been systematically adding to gold reserves. These are not traders. They do not check price charts every morning. When a central bank reallocates reserves into precious metals, that is a multi-year strategic decision. I'm not saying the dollar collapses next Tuesday. What I am saying is the math is getting harder to ignore. And silver tends to follow gold's macro signal while amplifying it, which is part of why the current setup is drawing attention from serious market participants. On the industrial side, the Silver Institute's most recent demand data continues to show a structural supply deficit, meaning global silver consumption has been exceeding new mine supply for multiple consecutive years. Now, a deficit is not a countdown timer. It is more like gravity. Gravity does not tell you the exact day something falls. It tells you the direction of the pressure. And if that pressure accumulates over multiple years, the system becomes increasingly sensitive to shocks. In this context, AI hardware manufacturing, solar panel rollout, both in the US and across the UK's North Sea Energy Transition Program, and medical devices all represent physical silver consumption that does not come back. Silver dispersed across electronics and solar cells is rarely recovered perfectly because it exists in tiny amounts spread across massive industrial volumes. I am not going to give you a precise ounce per megawatt figure because that would be false precision, and you deserve better than that. What the Silver Institute data shows is the direction of demand, and that direction has not reversed. If you have stayed with me this far, what is coming next is the part where I pull all of this together into the 3 lanes framework, and then give you the one specific thing I am personally watching this week. All right, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. Lane 1, the paper market. Futures positioning, margin environment, open interest. This week, the paper lane is showing maximum tension. Over 100,000 open contracts against 86.1 million registered ounces. per the CME warehouse report, as of March 6th. That ratio is historically elevated. The paper lane is flashing amber. Lane 2, the physical market. Premiums, vault withdrawals, dealer inventory. This week, the physical lane is confirming the paper signal. The 31% registered inventory drain is real and documented. The Western premium over Shanghai is real and documented. Physical is being pulled, not pushed back in. Lane 3, the macro lane. Dollar, rates, geopolitics, deficit math. This week, the macro lane is adding fuel. DXY below 99. Weak jobs data. A 10-year yield holding above 4% even with dollar weakness. Central bank accumulation continuing. In 15 years watching currency and commodity markets, the times I have seen all three lanes align in the same direction, even briefly, have historically been some of the most significant moments in these markets. I am not saying we are there today with absolute certainty. I am saying it is worth knowing what to watch for. When the paper lane is showing elevated contract to physical ratios, while the physical lane is showing active vault drainage, and the macro lane is pointing toward dollar weakness and institutional commodity rotation, the historical pattern has been price sensitivity to the upside on any physical demand shock. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week. One thing. The March delivery cycle on COMEX. Specifically, whether we see a meaningful uptick in delivery notices filed against that 86.1 million ounce registered base over the coming sessions. The CME publishes delivery notices daily. If we start seeing delivery demand accelerate while registered inventory stays flat or continues declining, that is the signal that the paper-to-physical tension is moving from theoretical to operational. If registered inventory stabilizes or eligible metal gets re-warranted into registered, meaning owners designate more metal as available, that tells me the pressure is easing and the squeeze narrative loses momentum for now. This is my one call for the week. John, FX Insider, on record. I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that today. Here is what needs to happen for the optimistic picture to develop. Registered inventory continues declining below 80 million ounces. Delivery demand picks up materially during the March cycle. Dollar weakness persists below the 99 level on the DXY. In that scenario, the pressure on physical settlement becomes genuinely structural and the price reaction could be significant. Here is what needs to happen for the cautious picture instead. The Fed signals it is not moved by one weak jobs report and holds its rate posture firm. The DXY recovers back toward 101. Eligible silver gets moved into registered, relieving the delivery pressure. In that scenario, the squeeze narrative fades, price pulls back, and we are probably looking at a retest of lower support levels. Both are genuinely possible right now. The honest answer is that nobody, not me, not the institutions, not the analysts, knows which of those two paths develops. What you can do is watch the specific signals I have named today. The market will tell you. Your job is to be watching the right things when it does. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you two things, and I genuinely want your answers, not just a thumbs up. First, are you currently holding physical silver, silver ETFs, or mining stocks? And has the vault drain story changed how you are thinking about your position size? Second, looking at the 3 lanes framework. I just walked you through which lane do you personally find most convincing right now? The paper tension, the physical drain, or the macro backdrop? Drop both answers below. The comment section here becomes a real-time sentiment tracker, and I read every single one. Subscribe because next week we are going into the CFTC commitment of traders data in detail, and I will show you exactly how to read managed money positioning as a leading indicator before price moves. That is a skill worth having. And if someone in your life is watching their stack right now and feeling confused about what is happening, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market, protect your currency.